Over the past few years, Cathie Wood has become the leading lady of the investment world. After correctly calling that Tesla's shares would increase by 20 times, she began to gain notoriety. And after returning a ridiculous 170% in 2020 with her ARK Innovation ETF, the excitement surrounding Cathie Wood has become almost palpable. Whenever anyone has such success in the investment arena, it creates division. On one side are her supporters, those that argue that she has been right so many times already, maybe we should listen to her. On the other side are those who say that after gaining 170% in the past year already, maybe the opportunity to invest with her has now gone. That's why, in this video, I'm going to break down the most important question today. Is now a good time to buy into Cathie Wood and ARK's ETFs? Or, after such an incredible run already, have investors missed most of the opportunity? Hi and welcome back. My name is Tom Hebe. I hope you're doing well. Let's get into it. But first, if you live in the US, Webull are currently offering this crazy deal right now. Open an account with them and you'll receive 2 free stocks worth between $5 and $500. Deposit $100 into your account and you'll receive another 2 free stocks worth this time between $16 and $3,200. So in total, that's 4 free stocks worth a minimum of $21 and all the way up to $3,700. All you have to do to claim your 4 free stocks is use the link in the description below. Just quickly, I am not a financial advisor, nor is this financial advice. Do your own due diligence and make your own decisions. Right, so let's get straight into it. Cathie and her team at ARK invest into companies driving forward innovation. Specifically, she believes there are 5 key areas of innovation that are going to disrupt the world in the coming months and years. Those 5 areas are: number 1, artificial intelligence; number 2, energy storage; number 3, robotics; number 4, gene sequencing; and finally number 5, blockchain technology. Now, when you begin to dig into each of these sectors, the opportunities are quite fascinating. And to be honest with you, pretty terrifying too. I mean, when I think of artificial intelligence combined with robotics, I'm just here picturing Arnie traveling back through time to make sure John Connor doesn't get born. Editing genes, and all I can think of is Gattaca. However, if these technologies are used responsibly, it's not hard to see how they could dramatically add value to our lives. Therefore, on the surface, investing into these technologies, it makes a lot of sense. But as someone who started investing in cryptocurrency in 2017, I know more than most people the importance of timing. Cathie's critics will often make the point that these technologies might someday change the world, but if you don't time it correctly, it's the same as being wrong. So the question is, are these technologies ready for mainstream adoption today or in the coming years? Well, Cathie uses Wright's law for this to make sure that she times her investments correctly. Wright's law says that for every cumulative doubling of units produced, costs will fall by a certain percentage. Or said in terms that we can all understand, as we produce more of something, such as batteries for electric cars, we become better at producing them. As a result, costs are going to fall. And the reason this is so important is because so many technologies might someday change the world, but to make a good investment, you need to time it right. Using Wright's law, Cathie Wood can determine when the costs of a technology have fallen to a level where they are ready for mainstream adoption in the coming years. In other words, not just a cool idea, but actually ready for adoption. Take gene sequencing, for example. The technology has been around for many years. However, the costs are only beginning to come to a realistic number now. Back in 2010, it cost over $100,000 to map out someone's genes. And I mean, sure, maybe the mega rich people would be happy to pay that, but I mean, it's not like us regular people are going to be paying $100,000. In 2020, these costs have fallen by 97% to a price of just $3,500. Now that's a huge drop, and it does make the technology more accessible, but for most people, that is going to be too steep. If prices continue to fall though, according to Wright's law, by 2025 it might only cost $100 to $200 to map out someone's genes. This is a great example because we can see how the technology was actually around in 2010. Therefore, you could have been investing all the way back at that time. However, at a price of over $100,000 per person, you're probably investing too early. Today though, we might only be a few years away from costs falling to a few $100s, and that may cause the technology to suddenly proliferate throughout society. So when it comes to timing her investments, Cathie is using Wright's Law to make sure she gets it right. At the same time though, people often say to her, yeah, but don't you think we're in a bubble? I mean, after all, the Fed is printing a crazy amount of money, interest rates are at all-time lows, and valuations are at all-time highs. I mean, on the surface, it certainly sounds like we're in a bubble. Well, I'll share my thoughts on this in a minute, but first let's hand it over to Cathie to hear why she doesn't believe the market is in a bubble.
But the other question, are we in a bubble? I do not believe so. And I am very happy that many people are worrying that we're in a bubble. I experienced the late 90s bubble, and yeah, the value investors out there were really worried, and they think they're going to have their day in the sun again because they did so well during the tech and telecom bust. I don't think that's the case now. I think that the seeds for what we're experiencing now were planted back then. Too much capital chased those opportunities too soon after too few opportunities, there were too few opportunities, and the technologies weren't right. The costs were way too high. We're at prime time for those 5 platforms now and those 14 technologies. And we've just begun.
So I've listened to a ridiculous amount of Cathie Wood's talks and interviews at this point, and the thing that she frequently brings up, as she did here too, is that these 5 technology platforms were previously in a bubble as people thought they were ready to disrupt. But those investors, they were too early to the party. Today, using Wright's Law, these technologies are on the precipice of major disruption. With this in mind, and looking at the relatively low valuation of some of these companies compared to their potential, Cathie makes the point that we can't be in a bubble. Now, in my opinion, I would say that it kind of varies from company to company. I mean, if you look at Tesla, for example, they are an amazing company, and because they cut across so many different sectors, battery storage, artificial intelligence, etc., they are not just a car manufacturer, and so they shouldn't be valued as just a car manufacturer. But at the same time though, looking at Tesla's valuation today, it's clear that investors are now pricing them based on high future expectations. And I mean, that's not to say that Tesla can't continue growing, because of course they certainly can. I'm just making the point that some companies are being priced on what they're doing today, and others are being priced on future promising expectations. Therefore, you can't really say all of these companies are in a bubble or that none of them are. It varies from company to company. However, Cathie takes her thoughts even further by sharing that she thinks 40% of the S&P 500 is about to be disrupted, meaning the traditional way of investing, it might not actually be as safe as you think. Again, let's hand it over to her first, and then I'll share my thoughts on this after.
So this message has been resonating out there, and investors are attracted to this space generally. But there are some investors who really want nothing to do with it because of the tech and telecom bubble and maybe the 08-09 meltdown. They just want to stick with the basic benchmarks and play it safe. Well, if you look at the S&P 500, we believe that about 40% of it is in the process of being disintermediated, disrupted. The other side of disruptive innovation is creative destruction. That is going to occur, we believe, to roughly somewhere between 35 and 40% of this so-called safe index. And I know that a lot of value investors are seeing great opportunities out there. And the really good value investors I know are going to do spectacularly out of this period. But for those who are just focused on price to book value of 35 to 40% of the S&P is going to be written down significantly. Exxon just wrote down, $30 billion last Friday. And we think that there are a number of areas, and we just put out a piece to help investors in these broad-based benchmarks understand what they are up against. The piece was called Bad Ideas. It mirrors our Big Ideas report that we put out every January. And we focused on 5 areas: banking, retail generally, television, linear television, rail, and traditional transportation. These are the 5 areas. These are all touching roughly 40% of the S&P, and they're all about to be disrupted.
So, Cathie believes that her investments are not in a bubble, but the S&P 500 might be in a pretty precarious situation with up to 40% of it in threat of disruption. Now, I don't know about you, but at this point, I'm pretty confused. On the one hand, my long-standing belief that the S&P 500 is one of the safest, high-performing investments you can make. At the same time, Cathie does make great points, she's been right in the past, and we haven't seen a time in history where 5 technology platforms are all ready to disrupt at the same time. So, how do we sort out our confusion and come to an answer? The answer that will probably make you happiest to hear is if I just told you that either Cathie is right and go with her, or she's totally wrong and stick with the S&P 500. But here's the thing, investing is not that simple. If you're confused, good, you should be. If you find yourself investing and you have no doubts whatsoever, let me tell you, you're probably missing something. The best investors in the world never know 100% on anything. There's always confusion. They just learn to balance the odds and they hedge their bets through diversification. So if we can't say that Cathie and her team at ARK are wrong, then it makes sense to consider adding them to a portfolio. After all, if they are right, even partially, then the opportunity is huge. And that brings us to 2 important things. Number 1, how much should an investor allocate to ARK's investments? And number 2, how long should an investor hold these investments for? Now, when it comes to the length of time to hold these investments for, let me just say clearly, these are investments into disruptive technology. What does that mean? That means these investments are highly volatile, and anyone approaching them with a short-term time horizon, anything less than 5 to 10 years, is essentially gambling. I'll give you an example to show you what I mean. This is Bitcoin's price chart from the peak of the 2017 bubble to the start of 2019. It's not a very pretty investment. Let's say you invested at the very peak of just under $20,000 and you sold 12 months later at $3,200. That's a loss of 84% in just 12 months. Now this is the same chart, but with the next 2 years included. If you bought at the exact peak, just like before, but this time you held for 3 years instead of just 12 months, you're now sitting on a 2x return. By the way, this chart is from CoinGecko, and shout out to anyone who uses them over CoinMarketCap. So much better. In the same time that Bitcoin is up 2x, the S&P 500 is up a lower 45%. Now, I'm not trying to make a point about Bitcoin versus the stock market or anything like that. I'm literally just referring to the numbers here. And Bitcoin is a really good example because it's volatile and Cathie Wood's investments are too. My point is just this. If you bought Bitcoin in 2017 at the very peak of the bubble and sold it for an 84% loss, you timed it poorly. If you bought Bitcoin at the exact same time and you held it for longer, you beat the stock market by a wide margin. And someday people may even look back and say you were very early at $20,000. So you timed it well, even though it's the exact same price. When it comes to timing the market, everyone is so focused on when to buy. But if you look at highly volatile disruptive technology, I think the biggest mistake is focusing too much on the buying and not thinking enough about the selling. If you buy with a short-term time horizon, that's usually going to be a mistake and you have to time it perfectly. I'm not going to sit here and tell you that Cathie and ARK's ETFs will be higher tomorrow, next week, next month, or even next year because I have no idea whatsoever. What I personally believe, and this is just my personal belief, I might not be right, but this is what I think, is that these technologies will disrupt industries and create huge opportunities. Therefore, between today and 20 years from now, there probably won't be many bigger opportunities around. Okay, so let's talk about how much of a portfolio it makes sense to invest with Cathie and ARK. But first, a few people have commented asking about how to invest in ARK's ETFs from the UK or Europe. So I'm going to do a full video on this in the future, but for now I just want to say a couple of helpful things. Firstly, you can take a look into apps such as Stake or IG. You can also take a look into the individual companies and create a portfolio for yourself using Trading 212. Or you can take a look into Scottish Mortgage Investment Trust. They aren't exactly the same as ARK, of course, but they do offer similar investments and are available to UK investors. Now, of course, you must do your own research, but hopefully these points should help you with that research. Okay, so how much to allocate to investing in innovation? Here we can see a mock-up that Cathie and ARK have put together, which includes 4 categories for a portfolio. Number 1, US stocks. Number 2, international stocks. Number 3, emerging markets. And number 4, innovation, such as ARK's ETFs. ARK have drawn up 3 example portfolios with investments into innovation included. A 10% investment into innovation, a 15% investment, and a 20% investment. The first thing to note is that the maximum value they've used is 20%. So even the leaders of innovation in investing are cognizant of the importance of diversification, i.e. not investing too much into innovation. Now the 2 main numbers to pay attention to here are the return and the standard deviation. According to this, the 20% innovation portfolio has the highest return, but it also has the highest volatility. So for each of us, our tolerance to volatility is different. People usually quote age here and they say that the younger you are, the more you can tolerate those big swings. To an extent, this is true, but it mostly comes down to what you are investing for. So as an example, I am currently saving up to move out and hopefully buy a place with my lovely girlfriend in the coming years. The majority of my money is invested for the long term, and that means a diversified mix of investments, including in innovation. However, because I also have a short-term goal in mind, some of my money has to be in safer investments, and I'm even painfully sitting on a small pile of cash. The cash to me especially just feels like a waste of my time, as I know that mathematically it's always best to be fully invested with the exception of an emergency fund. So I personally hate holding cash, but my priority today is to be 100% sure that we can move out, and that means I need to hold some cash. So the point is, I can't sit here and say what's best for you because I don't know your personal situation. All I can say is that history has shown us that ignoring disruption, generally speaking, is not wise. It's also not wise to invest too much heavily on disruption, especially with such a huge growth over the last year. I can't speak for you, but I can say that diversification, dollar cost averaging, and having a long-term time horizon are the strategies that I favor most. So every Tuesday and Friday, I share new videos like this. If you want to stay up to date with my investments and everything Cathie Wood, make sure you're subscribed. Let me know your thoughts in the comments. Are you investing with Cathie, or do you think the opportunity has passed? Thank you for watching. I will see you again very soon.